Hello, everybody, and welcome. I'm Mike Coe. Welcome to Open Mic on the Open Road. I am joining you today from Cape Cod, Massachusetts. And once again, if you cannot tell, I am doing my best to try to operate on my own without my usual paraphernalia and without my usual systems. Couple quick things. Obviously, on Wednesday, we spoke pretty extensively about why I thought it was important for shareholders to vote affirmatively for Elon Musk's pay package in the interest of fairness. I was responding to, I think, a well thought out article by Stephen Wilmot of the Wall Street Journal, who had written on June 5th why he did not think that shareholders should vote for that package. But I think happily it seems that as many of disinterested shareholders, that is to say, shareholders that do not include Elon Musk himself or his immediate family, seem to come to the same conclusion that I did. And I know that several of you who are watching did as well. And I'm happy about that. I don't necessarily think that that battle is over necessarily, but it certainly was a step in the right direction. Interestingly, one of the things that has happened since that time just got me thinking a little bit more about EVs, about charging, about the state of that industry. And part of that was the drive here. Those of you who joined on Wednesday know that I was joining you from New Hampshire. I'm now in Mid-Cape on Cape Cod. And interestingly, we had two cars down here, both conventional internal combustion engine vehicles, necessary in part because when it's not piping plover season, you can drive on the beach and things like that. We had visitors rent cars to come join us here. And in both cases, apparently because they were much cheaper, I know that one of the cars was rented from Budget Rent a Car. The other, I'm not exactly sure what company they used. But interestingly, both showed up in EVs. They had a Chevy Bolt, so an all-electric Chevy compact, and a Ford F-150 Lightning. And I bring this up because living in Northern California, as I do, I mean, I come to the Cape all the time, but not driving electric cars, so the availability of charging, things like that, weren't something that I'd really concern myself with, because where we are, we had a plug-in hybrid, we have a Tesla, and we have a charger at home, so it wasn't really much of an issue. Where we are, there is a huge number of fast charging options within, a circle of about 4 miles of where we live. You basically can't go a mile and a half without hitting a fast charger of some kind. For us, it's usually a supercharger, but we rarely use those because for those of you who have electric vehicles at home, chances are you have a charger at home unless you live in the city. So you just don't plug into these things that often. Having these things here made me realize just how much of a hassle it can be if there is not a lot of fast chargers. And I had the opportunity to try one from EVgo. That was pretty much a complete waste of time, a waste of a lot of time. 8 miles from where I sit. It's actually in Hyannis, Massachusetts. There are some others. We're going to be trying those soon. Why do I bring all of this up? The reason I bring it up is because, first of all, Ford entered into an agreement with Tesla to use their chargers, their superchargers. Now, the one that was rented that was sitting in the driveway here and will probably be returning shortly didn't have the necessary adapter to use the supercharger network. But it became very clear to me, using these other options, these other fast charging options, how far ahead of the game Tesla is with the superchargers. Number one, if you are driving a Tesla and the thing needs battery power, it will identify that. If it knows what route you're on, it will actually start preconditioning the battery, and it will make recommendations. Just go right here and plug right in. They're always fast. There's no app to fiddle with when you get there. You open the charge port, you plug it in. When you're done, and off you go. It is clear that either everyone else in the game is going to have to step it up considerably to match the efficiency, the simplicity, the availability of the supercharger network, or they're going to also, like Ford, need to make some kind of a deal with Tesla. So that's the first thing. The second thing that I was thinking about as I dealt with this was the fact that in the location where we currently sit, very few cars, understandably, because the charging situation is not that great, are electric. And one can think about opportunities to invest in this area by, for example, buying Tesla. Tesla was hard hit. I actually think that, I think we might have seen the worst of it behind us. So I tend to lean long Tesla. In general, it's part of the Holly Index. The other thing I would say, though, is that there are big swaths of the country that I've been to recently where there's essentially no electric vehicles. And if we don't know who's going to win in the EV charging space, but we do know that that's the direction that we're going to see. I've mentioned this before. I think utilities can be an interesting way to play it. So in this area, and here's the thing to think about, right? So first of all, there obviously has to be significantly more generative capacity to deal with the increased demand. So that's one part of it. But there are solutions that don't necessarily involve the utilities generation, but could involve their distribution, because every potential source is not going to run power lines to every single location. So the way I like to think about it is that the regional utilities could be kind of like an integrated oil company, both generating, distributing, marketing. So they could be the integrated oil companies do everything from E&P to the pipeline to the downstream business, which is the refining and marketing, right down to the gas station. So ExxonMobil is an E&P company. ExxonMobil has gas stations. I think of utilities in much the same way, that whatever the source of potential generation, whether it is theirs or otherwise, they are probably going to be, at the very least, the distribution mechanism. So with that in mind, I think it might be interesting to start, taking a look. Now, we know that there have been a number of utilities that have sort of seen this play already, and many are up considerably. There are some that have underperformed. I think about Eversource Energy, which is a Springfield, Massachusetts-based utility. They handle all of that. It's obviously the distribution generation also for natural gas. That's a little bit trickier because there are some locations now that includes California, but will probably include other CARB states, which seem to have a similar view on emissions that California does, CARB being the California Air Resources Board. California necessarily adopted much more stringent environmental regulations around vehicle emissions, particularly in the 1970s and ever since. That was necessary. There are certain parts of the world, California certainly has a couple of them, that because of their topography are particularly prone to air pollution in the form of smog. So if you think about Los Angeles, you have a basin, it is ringed by mountains, the wind is pushing against it. You have a lot of cars. I mean, there may be no city on earth that's more car culture driven than Los Angeles. And unsurprisingly, they had a lot of industry there too. Smog ended up building up. So I bring that up because in places like California, they have actually decided that they are not necessarily going to permit housing actually to have a natural gas anymore for stoves and things like that. So that can clip one portion of a utilities business if they are in the gas distribution business. But the flip side of it is that they are going to obviously have to sell more electrical power, assuming that individuals don't start increasingly generating at home in the form of having rooftop solar panels and that sort of thing. And that brings me to that other side of the equation, which is distribution. I know of people who have enough solar panels, especially in California, that they generate more power than they use. They sell power back to the grid. So in that instance, you're not dealing with utilities that are going to necessarily be generating the power, but they are still distributing the power. So Eversource Energy was just it's a hard hit name. It has not done particularly well. Actually, I think I have a mechanism here. Hopefully, you guys are going to be able to see this. Oh, okay. So actually, I'm starting to see your questions here. And okay, so I'm gonna deal with a couple of these questions in a second. I don't have my social media stuff that I normally do, but I'm gonna try to answer some of your question. Is ChargePoint DOA? So ChargePoint is not completely DOA. Let's take a look at ChargePoint first. It's interesting that you mentioned ChargePoint. We'll start with this one. So ChargePoint is a penny stock. That's the first thing I would say. We actually have a ChargePoint charger installed at our house, and we are going to be installing most likely a ChargePoint at this location as well. We just have to run a 50 amp, 240 volt circuit out to the end of the driveway, which is where we would want cars that are charged. We had a lot of cars, visitors and so on coming in and out of the driveway, so we wanted to have it out towards the end. So we have to run an underground cable for that. So it's interesting. ChargePoint, I think that their solution is decent. I'm under the impression that there are a lot of people who might be buying the individual stations that are unfamiliar. So, for example, in California, there was a $1,500 tax credit at the time that we did it, which, I think we had an electrician. It cost about 900 some odd bucks, and then the device itself was $600 or $700. Effectively, the tax credit offset the cost of the ChargePoint and its installation, which I think was the purpose. That they probably came up with the tax credit effectively to do that. The problem is that, these companies, several of them, they just didn't get quite the traction that one might hope. I'm actually going to share my screen here because when you're dealing with a company like this one, it becomes very difficult to trade options on it. I think, first of all, the stock itself is an option. And one of the issues you have when stocks become very, very cheap, couple of problems. Number one, the number of strikes relative to the stock price can be a problem. So let's actually take a look at this, and let's just say, for the sake of argument, that you're interested in buying a call option, and we can see that there's 50-cent strikes. Well, if you were dealing with 50-cent strikes in a $100 stock, that means that every strike is 50 basis points from spot, or 50 basis points of spot. Essentially, you can choose any strike you like in terms of percentages of the current stock price. For ChargePoint, which is $1.65, when you have $half strikes, it's really a problem because you cannot find this. You can never really seem to find a suitable strike. You can imagine if the stock's $1.50, 50-cent strikes, your strikes are 33% of the current stock price apart. Makes it very, very challenging to trade. And my problem here is that companies like ChargePoint, it's not that their business is completely hopeless, but it may be hopeless with their current balance sheet. What do I mean by that? So you can have a business that is viable, but it is not viable with the current level of debt, the current business structure. And some restructuring might be necessary, which means that some claims on the assets of the business are likely going to have to be restated. It's interesting. You hear this a lot by Ray Dalio. So when Ray Dalio talks about money printing, when he talks about debt, when he talks about equity, everything, he just thinks of all of these things as claims on assets. And I think that's a decent way to think about it. And there can come a time, and I think there is such a time in companies like ChargePoint, maybe, Lucid. Well, Lucid, I don't know. I'm not sure that Lucid is really viable. The car business is a very difficult one, and getting to profitability, as Tesla did, selling EVs, is the exception rather than the rule. Consider that the legacy automakers have been unsuccessful doing it. ChargePoint may be able to have a viable business, but I think that they're a little bit encumbered here. I don't mind it as a flyer. I actually was doing a bit of work with a family office that owned it at substantially higher levels, and they were wondering whether they should just blow it out where it currently sits. Now, I think they had a basis of $9 a share or something like that. So, my attitude about it was, well, if you treat it like a call option, like a lottery ticket, and you're willing to toss the rest of it away, then it's probably okay in that sense. But the company is losing money. It has negative cash flow. That's not sustainable. Something has to give. Something has to change. By the way, Kroger is going to be reporting on the 20th, so later this week. We're still dealing with a stock that's very low double-digit multiples, and I bring it up because people have to eat, and we saw Walmart earnings were okay. Not a growth story necessarily. It's one that I rather like, though, in the grocery space. Will it get any real traction? We'll see. Pays a nice dividend. So sort of a buy, hold, safe kind of name if you're thinking about it. Low volatility also, but I don't know that I would buy calls in it necessarily, simply because it's not a very high volatility name, and you're not going to get that dividend. But let's take a look. Why not? Let me just pull this back up again, and we'll take a look at that before I answer some of your other questions here. So if we were going to look to buy some call options in this, let's see, those are not the strikes we want to go here. So, well, that would be an in-the-money trade. That's probably not the way we would do it. But let's just take a look at, let's just say a 55 call spread. So that's $2 for a $5 call spread, already $1 in the money. That would be a potential way to play it. But again, you're dealing with a company that, you could just buy the stock and try to, collect a more than 2% dividend yield as well. I think either is fine. I will say I would not sell call options going into earnings. I just don't think you're getting enough for them. Bear in mind also that my friend and has not a professional colleague. We haven't worked together, but somebody I've known a long time, Matt Amerson at ORATS, which was Options Research and Trading Services. He's done a lot of work on selling calls, and basically, if we were going to distill his research on covered call selling on single stocks, going into earnings is not a good idea. Seems like the options markets price these things pretty well. So you're usually not going to get a whole lot of extra return by selling. It seems like it. You're going to see elevated options premiums. Not necessarily a great trade, though. Okay, so let's take a look at some of these other questions. Now, I'd throw these up in a lower third for you if I could, but just operating as you see me here. As you can see, wearing I was about to say a golf shirt, but this thing says tennis on it, so I guess it's this is a tennis shirt. By the way, this guy also operates a YouTube channel. He used to run the Brad Gilbert, the tennis store in Green Bay, California, which is where I get my rackets restrung. So very, very nice guy. You can check if you are into tennis. It's an interesting tennis channel because he often talks about equipment. It's not like My Tennis. My Tennis HQ, a great tennis channel for a guy who's pro at 30. But anyway, just bothered to mention that. Okay, So the first question comes from MM. Hi, Mike. What's your favorite retail trading platform for all types of functionality? So I'm reluctant to promote any platform. I don't have, and I haven't. Also, in fairness, I should say I haven't tried every single one of them. They are all seemingly getting a lot better. I will say the following though: Interactive Brokers has access to a lot of markets, which is really helpful. So international markets, if you happen to trade them, futures, obviously options on futures, you have a lot of access. TD Ameritrade had built out, really made an effort on the futures side, which I thought was good. And they had a lot of other supporting functionality as well. It was a platform, Thinkorswim, which is where all of that came from. So it went Thinkorswim, that got acquired by TD Ameritrade, which in turn got acquired by Schwab. Tom Sosnoff, JJ Kinahan, the guys that built Thinkorswim originally, these were traders. These guys were in the business. JJ Kinahan was on the CBOE. Tom is a trader. All of the people on that team, they're not salesmen. They are market practitioners. So they built things that they thought they would want. They built things that they thought people should look at because based on their experience, they wanted that kind of functionality. So I think that platform is also fine. And I'm seeing some other platforms coming online. So it's worth noting, I have not used Tasty Trade's platform, but it's the same cast. JJ rejoined them. Tom Sosnoff and Tony Batista and all these guys, they're real guys. They came from the business. They've been in the business the whole time. They build platforms that have functionality that they like for the markets that they trade. So, I have every bit of faith, although I haven't used it, that if my experience with anything else that they've built previously is any indication, I'm sure they're very good. I have not used E-Trade, so I can't really speak to it. But I would say I'm a little reluctant to encourage people to use, and this is, it's not a knock on what the folks at Robinhood are trying to do or anything like that, but some of those platforms were not built by traders. That's the first thing. The second thing is that they were built off of an economic model that relies on payment for order flow. Most of these platforms take payment for order flow. If you don't know what payment for order flow is, I'll just explain it very quickly. I was actually one of the first market participants to be engaged on it from the paying side. So what payment for order flow is a pretty simple concept. You have market makers and dealers. Those are the ones that are lighting up whenever you see a bid or you see an ask. That's the market making community. I'm as a former market maker and specialist. And of course, you have those that are providing the retail flow. So that could be the retail brokerage platforms, or in a prior life when things were less electronic, Payne Weber, Merrill Lynch, whatever. Everybody who represented retail accounts, and sometimes not retail, they have to elect where they're going to direct their business. It's a competitive market. So you don't just make a market and try to make the best bid or offer. As the number of options exchanges and other exchanges and ECNs has proliferated, those who route those orders for execution have a lot more choices about where to send them. Originally, products were single listed. So if you wanted to trade Microsoft options, those went to the Pacific Exchange. That's where they traded. If you wanted to trade Dell options, they had to go to the PHLX, the Philadelphia Exchange. That's where they traded. You wanted to trade Intel, that was an Amex product. IBM and Ford were CBOE products. And there were only those 4 exchanges. So as more exchanges came online, and really where multiple listing came up was around the same time as the introduction of the ICE, the ISE, not the ICE. So ISE is the International Securities Exchange. As that came online, then all of a sudden market making firms on different exchanges started listing products that were previously only listed in one place. Then, in order to encourage the brokerage firms to direct their order flow to that exchange, they would give them rebates. So there are exchange rebates that do this. There are essentially what we sometimes refer to as card rates, which is just the standard rate that dealers remit back for payment for order flow. And there are negotiated rates, and they can vary by type. So a market order or a marketable limit order may get paid something different than what a basic limit order would. Spread orders get something else. This is not, we're not going to hold a referendum now on the benefits of payment for order flow, good or bad. Obviously, all of this goes into the notion of best execution. So you want to pay the lowest possible commission, you want to get a fast execution, and you want to get the best possible price. When you combine all of those things, then you're getting the best execution. Payment for order flow did permit retail market participants to trade options without paying a commission. Essentially, that cost was being borne by the market makers. Now, in some cases, presumably all of these economics can impact the cost, but in some cases, they really don't. If you're dealing with SPY options, those things could be a penny wide, 2 cents wide. They can't actually trade any tighter than that. So if you're able to trade these things at no commission, no fee, that's ideal for the retail side. In other cases, it may not be as advantageous because some of these things trade by appointment. So Robinhood and platforms like that, which are only based on that, weren't necessarily built by traders for traders. In fairness, again, not trying to impugn anybody, but they were really intended to be for people who hadn't traded before. Simple, app-based. You could do it on your phone. Never traded before, no problem. Start with $100, whatever. That's fine. But as you mature as an investor, as you mature as a trader, you want to start trading futures. You probably want to graduate to the more sophisticated platforms. I would add something else, and that is that the big platforms aren't going to run into trouble with their capital, with the firm capital. So, I'm not intimately involved with it, but we can recall that when the Reddit rebellion meme stock craze really got going, and GameStop had the short squeeze, the first one, not talking about the most recent one. A lot of people who traded at Robinhood were unable to trade. And one of the things that was suggested was because they had some capital constraints. Now, that was not the only thing that the management of Robinhood had to concern themselves with. But it's just not something you ever want to deal with as a client of a brokerage firm. And why? There's no need to. So I would say any and all of those are FinWest just says IBKR is terrific, reliable and good fills, which is essential. So it's also interesting that some platforms also had mechanisms to internalize the flow. And what I mean by that is that if you were doing a complex trade like a spread, Interactive Brokers actually used to show you an inside market. So effectively, their own quote engines were piping in. So if you built something, built out a spread, you could see what the touch of the market was. Touch means, let's say I'm buying one option, selling another. So it would show me the ask price for the one I'm buying, the bid price for the one I'm selling, and that would be the touch market. Interactive Brokers' own platform, when you built it, would show you an inside market, which effectively was their internal quotes, which they could take from their own market-making community, so Interactive's market-making firm was called Timber Hill. And some of these platforms can actually get those piped in by other market participants. Best I could tell, that's no longer the case because Timber Hill essentially, Tom Petterfy, I guess, decided he wasn't going to be engaged in that business anymore. So that's kind of gone now. But these bigger platforms, they do have the capability to do that. I know that there's a lot of people who don't want to use systems that were built by market makers because they assume that the market because they're going to be trading against the market maker, they're assuming that their interests are opposed and therefore they shouldn't use it. I can understand that sentiment, but there is a counterpoint I would offer, which is that if you use something like WEX, Wolverine's execution, Wolverine is a big market making firm. I've dealt with them in the past, haven't dealt with them much recently because I'm not in that game anymore, but friends with a former Wolverine partner. These people know what they're doing. They know how to build trading systems. This is what they do. And when they build a platform, they're trying to build it in a way that it is competitive with whatever else is out there. And while, of course, they're hoping that it's going to direct flow to them, they also know what the flaws in other systems are, and that's why they build them. They say, well, this is not done right. I think we can do better. So here's what we're going to do. And they build out algorithms that can be good in that sense. So Finwest adds something here. This is another important point, actually. So the platform isn't just about the algos that you use, the layouts, market access. In his case, he's pointing out that he's getting a good short rebate. So effectively, in margin accounts, when shares are held in street name, those are shares that are available to lend. It's one of the very strange things I've heard about. I see people talking about the meme stocks or about GameStop, and they'll say, oh, somebody bought those shares and, quote, took them off the market. That's not how this works. That is not how this works. If you buy shares and you have them registered in your name and you take hold of the certificate, the actual certificate that says I own these shares, those shares cannot be loaned by a broker because they're not their shares to lend. But that's not actually how most of us trade anymore. When you buy or sell shares, most of those shares are going to be held, what we say, the way it's referred to is in street name. So if you trade at E-Trade, it's going to show up as Morgan Stanley, which now owns them, or Interactive. The holding of the shares is going to be in their name. And their securities lending operation can lend those shares. And they will do so at whatever the prevailing rate is. So if a stock becomes hard to borrow or almost impossible to borrow, they will increase the cost to borrow those shares. And as Finwest points out, if you are a customer of a transparent brokerage platform that defines how much they're going to charge you up front, and then everything else is a pass-through, so they essentially charge some markup, call it 10, 15, 25 cents a contract, whatever it is, and maybe they charge an interest rate spread, so you borrow at one rate and lend at another, you will actually see that benefit. So you don't need to do convoluted trades to try to take advantage of a high borrow cost. So if you're at a brokerage firm that does not pass on, if you own GameStop shares and let's say the borrow cost on that is 24% annualized, 2% a month, and you want to take that 2% in, and you expect to because you want to loan your shares out, at some brokerage platforms, that's not going to happen. And you can still do it, but the way you have to do it is you actually have to effect an options trade. So what you would do is you would reverse. What that means is you would buy calls in that stock at a certain strike and certain expiration. You would sell the corresponding put, same strike, same expiration. So that's basically a synthetic long position, and then sell the stock. And if the borrow cost is very high, you'll get paid a favorable amount to effect that transaction. And effectively, you're extending, the only thing you're really doing is extending a term loan on the stock. And you're doing that because your broker won't pay you the short rebate, which you should be getting. So, good point. There are brokerage platforms. That's something you really want to check, actually. In some ways, I think that's as important as anything. See whether or not you have favorable rates. What's your long rate? What's your short rate? Do you get a pass through on short, when stocks go hard to borrow that you hold, are you going to get paid? You can still trade around that, but it's cumbersome to do so. So if you have a broker that's more transparent and does that, that's a better deal. Okay, so MM says, I live in North Carolina and would never consider EV until charging infrastructure is mainstream, and how do I, of course I did something so that I blocked that message. I can't see it. Oops. How do I do this? There we are. I live in North Carolina, and I would never consider EV until charging infrastructure is mainstream and range improvements take hold. So I'm a bit of a car guy. Not so much since I had kids and all that. We have to sort of be a little bit practical about things. But we've had 2 Teslas. I had a plug-in hybrid, and I will say this. And if you have not driven a Tesla, I think it's probably you need to compared to other EVs. 300-mile range. Does my gas car have? We have 2 conventional cars. One's actually one's a mild hybrid, but I'm not really sure what's hybrid about it, to be honest. I think there's an electric supercharger in it or something. I have a Land Rover Defender they say it's a mild hybrid, but it's not a plug-in. Doesn't get very good mileage, to be honest. But the Teslas are a very special experience as far as I'm concerned. It's a great car, and it's a great car for the money. It has a great range, and for most of your day-to-day driving around your home, if you have a charger, you are set with that thing. I think it's a spectacular value. That's all I can say. I have driven other electric cars, driven this Chevy Bolt now. I've driven this F-150 Lightning. Have friends who have Rivians. They love those, by the way. But the biggest point is that if you have a Tesla and you think about taking it a longer distance, you can do that because of the supercharger network. Any other car, if you absolutely positively have to log some miles, I agree with you. I think it's very, very difficult. And I'm seeing that here. I mean, it is a pain. It is a real pain to try to figure out how to charge these cars that are sitting in the driveway right now. When we plug them in here without having the 240 volt, it's ludicrous. Really is. Solar panels, one thing. Storage is the problem. Yeah, so it's interesting. That comment comes from Red State Ron. So Ron, yeah, quick point I would make about that. I have a friend he's installed. Again, it's going to vary where you live. So many things impact this. Cold weather really impacts the range on an electric vehicle. We have driven 2 different Teslas, a Model X and a Model Y, up to Lake Tahoe from the Bay Area, left those cars outside overnight and gone out, and the range that the car is showing is, maybe 30% lower than it was when you went to bed the prior night. That's a difficult situation, and not particularly pleasant. So I think that's an issue. Solar panels, you want to be in a place where it's sunny most of the time. Where we are, I think it's sunny 300 days. I think New Mexico, you can live in places where it's sunny 330 days out of the year. It's like every day except 1 month of the year is sunny. So that obviously makes a difference. In terms of storage, the Tesla Powerwalls, I don't have one of those, but I know people who do. They swear by them. In fact, actually, one of my friends got one, loved it, put in another one, ended up with 4 of them. He's got 4 Tesla Powerwalls, and Teslas are the only thing they drive now. But we live in the ideal situation. Moderate climate, sunny most of the time. For a lot of people, it's just not there. I can see that. Here, it's unbelievable. Massachusetts is a CARB state. They follow the California Air Resource Board emissions rules for cars sold. But it's not EV friendly where we are, not at all. Okay, so thoughts on buying July 19th, 485 at the money triple Q put. Interesting. That one from Bob Lomi or Loam. I apologize if I'm mispronouncing that. Well, let's actually take a look at these. I'm going to just quickly pull this up. it does feel to me like the market just continues to have some momentum. I have said on more than one occasion now that the market this one feels most like to me in my professional life is 1999. And, if you're thinking about that, you could say, well, we all know how that turned out. True enough. Turned out very badly. If you were in the NASDAQ 100, it was a complete disaster, of course, ultimately. But it was not 1999 that did it. The market continued to rally through March of 2000 before it really started to roll over. And this feels a lot like that to me. That is to say, it actually feels a lot like the 99 portion and not the 2000 portion. Markets generally rise in election years. We are in one, although certainly an unconventional one. Here's the warning sign I would, actually before I pull up let's just take a look. I'm going to start by just taking a look at the puts you're talking about, which were the July 19th 485s. So let's pick those out. We'll just take a midpoint here. Look at what you're paying, which is not a lot. $8, round numbers. So well less than 2% of the current level. I think you can buy these things, and I have a feeling you will actually be able to take them off at a profit. Is that because I actually think that the market is going to crack here and now? No, not necessarily. It's not that I think the market is fairly valued. I think there's a couple high flyers that are by now a little overvalued. People have gotten a bit too enthusiastic, but I'm not going to sit here and try to call the top. I will say this, though. There was one indicator before the March 2000 peak. One of the things we saw was that, and this is one of the reasons why I don't really think that this is necessarily it. In 2000, right before the market rolled over, the market rallied, but so did vol. Both were rising. What do we usually see? What we usually see is that as the market sort of steadily marches from the lower left to the upper right, that volatility is relatively subdued. And in some cases, that can be a setup, like it was with Volmageddon. 2017, we saw epically low realized and implied volatility, down to 7, I think, or so that December. And that was because we just had huge amounts of vol selling that compressed realized vol, and it also compressed implied vol. And then we had an ETP crack, and that created Volmageddon, and we had that big spike. What happened in early 2000 was that in many names we started seeing these sort of breathtaking swoons in stocks in the short term. They would ultimately go higher, but we would see these big gaps in names like Cisco. I think Cisco is probably the best poster child for that era. And that's something that I think if you start seeing that, watch out. Because what that really means is that there's nothing holding it up. That's my read, is that if you start seeing elevated volatility as the market goes higher, that's a problem. And that's also the kind of situation that's likely to create, not a technical analyst, although I do listen to them, as I often say, and I look at certain technicals. But when I was a futures trader, the downside reversal was the most bearish thing that could happen at any moment. Downside reversal, that's when basically open higher, trade to new highs and close lower. And that's the kind of situation that we started to get around that time frame. We just started seeing much choppier movements. Even though the markets were still going higher, we started seeing some pretty wild stuff in individual stocks, and the overall level of volatility in the market increased even as the market went higher. But I think you will be able to trade out of those for a profit because the markets don't typically go up in a straight line. And actually, we've had, we have a little gap in here in that 470 level for the Qs. I think, you could potentially play in that area. Okay. Joseph Kamen went to Tasty Trade. Thinkorswim is awesome. I'm hearing from Corey Henderson. Look, these two platforms were built by the same people, right? So same guys built them. Tasty trade more recently, but yeah. And let's see what else we have here. You're going to have to forgive me because I'm doing this like that. Okay, and Joseph also asking, seven-figure permission is saying tech bubble. Yeah, I think so. I think this is another, I think we are in another tech bubble, to be honest. But bubbles can get pretty big before they pop. And I'm not clear. It's not clear to me that this one's about to right now. Again, I'm just saying that the market doesn't repeat itself perfectly. History doesn't repeat perfectly. It does tend to rhyme. This rhymes with 99 to me. So there is a question here about CrowdStrike, actually. And so it was Joseph Kamen again, who was asking about it. And let's take, so CrowdStrike closed on June 7th, out of the money. See if I can follow the question here. CrowdStrike closed on June 7th, out of the money expiration, but carried $6 of extrinsic value into and through the close. At 5:30, they were then added to the S&P 500. I was assigned on a short call. Why? Yes. Okay. Great question, and an important. What I'm about to say here is important for two reasons. Whether you are long options or you are short them, you can be. So we know of automatic exercise. So stock is trading 101. You're short the $100 call. So the call you're short is $1 in the money. You can expect to be assigned, but don't assume that that's 100%. And the reason is that news can come out after the close, and that news, there is a window of time between which the market closes and the window to file what's called a contrary exercise notice closes. Now, that can vary slightly from broker to broker. It is for this reason that every expiration Friday, when I was a market maker, and they were not as frequent. Now we have weeklies, daily options, and SPX. SPX isn't an issue because it settles to cash, but we didn't have weekly options in the beginning. So every regular way Friday, we had to concern ourselves with options that were very close to the money, at, just out, just in. And we would have to sit around until 5:30, which was the last moment at which we could file a contrary exercise notice. And when I was at Cantor, we were self-clearing, so it's just a mechanism on the systems that tie you to the OCC. And effectively, if the stock moves after hours, yes, there is a chance that a holder of an option will elect either not to exercise an option that you would otherwise think would be. $101 stock falls to 99, and they say, you know what? So they file even though it will automatically exercise because the closing price was 101, if it's trading 99, they'll file a contrary exercise notice and not. And it's important for you all because if you hold an option and you know that there's news coming out after the close on an expiration day that may significantly impact the price, this is a perfect example of that. Addition to the S&P 500, how's that going to impact it? You also have that option, but what you do need to do is find out with your own brokerage firm when that window closes. It's usually 5 o'clock, I think, for most brokers, but check with yours. Contrary exercise notice, what's the deadline for filing a contrary exercise notice? If you hold options, that's important. And even, if you're short options, it's important because you can then sort of guess based on how the stock is trading after hours whether or not that's going to happen. One other point, and this is a nuance thing, if you believe, if there's not a lot of open interest, and for whatever reason you think retail's on the other side of your open interest, the chances that there's going to be a contrary exercise notice go down significantly. because most people are not looking at this. They're not going to bother. They may not even know how to do it. But for the most part, you're dealing with dealers on the other side. They do know, and they are watching, and they're going to wait until the last possible instant to make a decision. So, okay. And let's see. I think that pretty much covers most of those questions. And I appreciate those of you who are tuning in and watching these. I'm doing my best with what I've got here. Hopefully, because I'm going to be here for a couple of weeks, I think, I'm going to have at least one of my own laptops set up and get the Bloomberg going and things like that once again. But in the meantime, this sort of more ad hoc format, for those of you who watch, I really appreciate it. Hope you like, subscribe, do all that kind of good stuff, the things that YouTubers like, because I think in this context, that's how I can refer to myself, a YouTube presenter. And I hope you guys are seeing a good summer kickoff, and we'll be sure to tune in on Wednesday, 4:15, when I'm going to do this again with a few more tools, things like that. And comments, questions, keep them coming. Really appreciate your time.